First, we're the final day of the third quarter with stocks trading near all-time highs. Next big test for the markets will be the jobs print on Friday. For more on what to expect, let's bring in Matt Stucky. He's a chief portfolio manager for equities at Northwestern Mutual Wealth Management. Matt, it's great to have you here. So here we are wrapping up the third quarter. It's been a much stronger than expected month here for stocks. As we look ahead to the next quarter and beyond, what do you think is the biggest driver? What investors should be most focused on?
You know, I think the focus really needs to be on employment. And what I mean by here is that since the beginning part of this year, you've seen employment start to gradually deteriorate. And the question is whether or not we've kind of crossed that path of no return where, a little bit of weakening becomes a lot of weakening. And one of the areas that we're focusing in on is the difference between cyclical employment and non-cyclical employment. So cyclical employment takes everything out of the jobs report except for things like education, healthcare, and government jobs. And if you look at that cyclical component, which is roughly 70% of the jobs here in the United States, it peaked in February of this year, and actually we've lost roughly 300,000 jobs cumulatively since then. So the health of the labor market on a go-forward basis is really what we're focusing in on here for the rest of 2024.
How could some of that cyclicality that you just described, Matt, play into what we might see in the earnings season coming up in Q4 here?
We just got off the back of a really good earnings season in Q2 that was reported in Q3. What was really a standout point for me was just the increasing breadth of earnings growth. Within the second quarter, there were only two sectors in the S&P 500 where you saw negative earnings growth. You saw positive earnings growth north of around 10% for 5 of the different sectors, which was a big improvement in terms of breadth versus Q1. We need to see that continue to broaden out as you look at Q3 earnings season, which should be on the docket here in the next few weeks for reporting purposes. That to me is really kind of where we need to see the fundamentals pull through for the market to continue to move higher.
Do you think we likely will? I guess what is factored into your base case?
My base case is that maybe we're a little bit over our ski tips in terms of expectations. Earnings growth for 2024 looks like it's going to be kind of right around 9 or 10% for the entirety of this year. But if you look at next year, those earnings are expected to reaccelerate up to around 14-15% growth. To me, that's a pretty rosy expectation, especially considering the comments I made about the difference between cyclical and non-cyclical employment. You need employment to be stable, if not improving, for earnings growth to reaccelerate into next year.
And what does that tell us specifically about large caps, some of those big tech names? We've talked a lot this morning about how the growth of this market has really rotated away from that AI rally and over into some more defensive corners of the market like utilities. How do you anticipate that impacting your positioning heading into year end?
I would best classify the current economic environment as being late cycle. And in late cycle environments, investors tend to gravitate towards quality. They tend to gravitate towards defensive. And you tend to see that kind of over-indexed in the U.S. large cap asset class. You mentioned utilities. That is the classic defensive area of the S&P 500, albeit with maybe an AI sweetener in here in 2024. But as you look to kind of 2025 and beyond, kind of really what investors are going to be looking for is consistent high margin earnings growth. And really that's kind of been the mega cap tech trade for some time. If you do get a reacceleration in fundamental growth, however, there are much more attractive areas to invest from a purely a valuation standpoint. Think small caps that trade 14 times earnings that are more sensitive to the economy if the economy were to reaccelerate next year. So things like that are other areas to look if the macro case were to pivot into kind of more of a soft landing environment.
And Matt, what would give you a little bit more confidence that we are seeing that soft landing? I guess if investors do want to maybe have a little bit more exposure to those quote unquote riskier areas.
Yeah, I think what I want to see is some stabilization and reacceleration in the ISM indexes. So look at the ISM manufacturing index. For about 2 years or so, it's been in kind of recession territory. The ISM services component, which is the vast majority of the U.S. economy, has been doing okay, but it has softened somewhat, especially the employment component. I want to see both of those stabilize and reaccelerate to the upside. To me, that is the call then that the economy has kind of survived a lot of the tightening that the Federal Reserve has put in place. We're not there yet, but that's the place to watch.